Ever wondered if your stock portfolio has more in common with ancient Babylonian clay tablets than Silicon Valley algorithms? Because it does. Forget Wall Street. Forget London banks. The foundations of modern finance were built thousands of years ago in dusty marketplaces along dangerous trade routes and inside temples that functioned like banks. Today, we're uncovering the surprising truth: futures, loans, credit, insurance, even derivatives are ancient inventions. And once you see it, you'll never look at money the same way again. 4,000 years ago, in Mesopotamia, traders faced a huge problem. Trade was incredibly risky. Harvests could fail. Caravans could get robbed. So they did what humans do best. They innovated. The Babylonians started recording financial contracts on clay tablets. These weren't just IOUs. They were legally binding agreements stored securely in temples which acted like public archives. What was on these tablets? Things like loans with interest, clear repayment schedules, and even collateral agreements. Does any of that sound familiar? The famous Code of Hammurabi, one of the oldest deciphered writings of significant length in the world, even had laws that regulated interest rates and penalties for default. This was the world's first financial regulation. This wasn't some primitive form of finance. It was structured, it was legally enforced, and it was scalable. It was the blueprint for everything that would come next. And here's something that might really surprise you. The first futures contracts weren't dreamed up by sharp-suited bankers in a skyscraper. They were invented by farmers. Picture this: a Babylonian farmer worried about what the price of barley will be at harvest time. To protect himself, he makes an agreement today to sell his future barley crop at a fixed price months in advance. This protects him from a price crash, and it protects the buyer from a price spike. That simple agreement is a futures contract, the very same logic that drives today's oil futures, commodity trading, and all those complex derivatives. It was invented thousands of years ago to protect farmers from the uncertainty of Mother Nature. It shows that complex finance didn't begin with greed. It began as a tool for managing risk. Now, let's leave the fields of Babylon and set sail to ancient Greece. Sea trade was the engine of their economy, but it was incredibly dangerous. Ships sank, pirates attacked, and violent storms could wipe out an entire cargo in an instant. The risk was enormous. So Greek merchants created something truly revolutionary: bottom-rate loans. Here's how it worked. A lender would finance a merchant's voyage. If the ship made it back to port safely, the loan was repaid with a very high interest rate. But if the ship was lost at sea, the debt was completely forgiven. The lender lost everything. This is the direct ancestor of modern insurance. Instead of trying to avoid risk, they found a way to share it across the community. This innovation was critical. Without it, global trade as we know it might never have taken off. The Romans, of course, took finance and scaled it up to an imperial level. They created private banks, credit accounts, and even clearing systems that allowed money to be moved across their vast empire without physically carrying sacks of gold. Imagine being able to settle a debt in Britain with a creditor in Egypt through a simple written order. That's essentially an early form of a check. The Romans also used a system that looked a lot like fractional reserve banking, where banks would lend out more money than they actually held in their vaults. Sound dangerous? Well, it was. And just like today, when things went wrong, financial crashes happened. Ancient Rome proved a timeless truth. Finance is a powerful tool that can amplify both prosperity and collapse. As we move forward in time to the Islamic Golden Age, finance became even more sophisticated, evolving with strong ethical and mathematical principles. This era gave us incredible innovations. The sack, a written promise to pay, was a letter of credit that could be cashed in a different city. In fact, the word check comes directly from sack. Instead of charging pure interest, which was often prohibited, they developed partnership-based investing and risk-sharing models. A merchant could travel all the way from Spain to India relying entirely on these financial trust networks without carrying a single piece of gold. Modern global banking owes far more to this period of history than most of our textbooks admit. So here's the big realization. Modern finance didn't just appear out of nowhere. It evolved slowly over thousands of years because humans, no matter the era, kept facing the same fundamental problems. How do we manage risk? How do we trade with people over vast distances? And most importantly, how do we build trust with strangers? The technology has obviously changed. Our clay tablets are now digital trading apps, and our caravans are global supply chains. But the core human problems haven't changed at all. Your fancy trading app is just a much faster version of ideas that were born in antiquity. So the next time you hear someone say that finance is a cold, modern, or artificial creation, remember its true story. It's one of humanity's oldest and most essential survival tools. It was built not just on calculations and greed, but on the fundamental human values of trust, cooperation, and the sharing of risk. The future of finance isn't disconnected from its past. It's built right on top of it. Thanks for watching.